When I walk through the door, I'm talking cash flow. And if you know, like I know, you getting cash flow. Rule one, getting money, never losing no. But I'm broke, but now I'm living at it. They just count my zeros and some decimals. And I wish you would try to test me, yo. You should listen to the lesson, no. Masterminds out of Mexico, I invested though when I let it grow. Benjamins, I got a pocket full. Rich income and your taxes low. Spend it right and then invest some more. And if you don't believe me, ask my doctor though. What you mean? You mean Uncle G? Planting seeds for these money trees. Who got my money, please? Everywhere you wanna be like Visa, MasterCard, American Express. I bought the bank and I bought the checks. I buy apartments, I send checks. Yo, billionaire went undercover, help y'all discover who did it best. Just bought 2 choppers, can't wait till they see the face and they see what I do next. When I walk through the door.
Hey guys, welcome. Happy Wednesday.
And if you know, like I know, you getting cash flow. When I walk through the door, I'm talking cash flow. And if you know, like I know, you getting cash flow.
Yeah, and only then do I buy something stupid. How stupid can you go? You can go as stupid as your cash flow.
You know what heals all ills? Deals. Look who went from meals to bills. It's eat what you kill when you're in the field. And the pipeline overflowing, I don't drip, I spill. We don't seek balance, nah, we want extraordinary. If you really knew my dreams, it'd be more than scary. We got more to spare, ain't no shortage, baby. Winning by the chopper and another for my lady. Talking about the bird and the strap, say the word and she handle that. Fully loaded, put it at the target and you know we letting off every man. Got money, who got my back? You can never get it if you never ask. Big bags, legendary swag. Only one thing better than cash. When I walk through the door, I'm talking cash flow. And if you know, like I know, you getting cash flow. When I walk through the door, I'm talking cash flow. And if you know, like I know, you getting cash flow. When I walk through, no I won't do, no I won't do, no I'm talking to, not to, you know about to do, what? Walk in that door.
All right. I'm going to get started here. Let me know how has your day been going so far in the chat. All right, let's get started. So hello, everyone. Happy Wednesday. Welcome to the Multifamily Freedom Chasers Financing Zoom. Before I move any further, can everybody hear me? Good.
Yes.
Awesome. My name is Shelly Miles. I am a commercial mortgage broker and a co-founder of Adventure Commercial Capital, together with Mr. Jerry Miles over there. What our company does is connect real estate investors to lenders. Real estate investors that would like to buy multifamily, fix and flip, storage units, hotels, any business that has real estate attached to it, our company can connect you to a lender, because each investor is unique and each deal is unique. We have the skills to understand what you need and connect you to the right lender. Jerry, you want to go ahead and take over? If you're new, can you let us know? Put a 1 in the chat so we can recognize you if you're new. If you've been here before, put a 2 in the chat. James is a little new. Oh, okay, good. We've got some regulars. Awesome. Welcome, James and Michael and Alicia. Sorry if I butcher your name, my bad. Jerry, you want to go ahead and take over?
I will. Yeah, I am Jerry Miles, the other half of Shelly Miles. Um, Today's agenda will kind of go through our community, the Multifamily Freedom Chasers community ecosystem. We'll do some introductions. We'll introduce ourselves and do let a couple people come and introduce themselves as well. We'll go through the current debt market. And then the main topic tonight we'll be talking about agency financing, and at the end we'll have some time for Q&A. So the Multifamily Freedom Chasers community, I believe we are now on our second year. I know we are on a second year with the Freedom Chasers. Been around for, I guess, a year and a half now as far as the Freedom Chasers community. But we do educational Zooms 2 nights a week on Mondays and Wednesdays. And Mondays we have Trevor alternating weeks with BB and Iffy. Trevor usually has a guest speaker, really good content, celebrity guests, things along those lines. BB and Iffy are active asset managers and syndicators, and they are on here talking about how to manage assets and how to grow your portfolios. On alternating Wednesdays, you have me and my wife here talking about the financing part of real estate investing, and we alternate Wednesdays with Kevin and Ed. They are both commercial brokers, and they talk about underwriting, deal sourcing, and relationships with brokers and things. So these calls are top notch. Everybody here is involved in the space. We're all professionals in the real estate space, and we're here to provide education and to help the community grow. So join as many of these as you can, and connect with as many people as you can. We've had people that have connected through the chat on our Zoom calls here that have done business together. So we had a local contractor here that we go to church with that is rehabbing a 12-unit building for someone that they met here on this chat. So it's a good place to meet people.
Yeah, and if you're not a part of the Multi-Freedom Chasers Facebook group yet, I just shared the link on there. You will get all the event updates for every Zoom call Jerry just mentioned. On there, you'll get notification for those. So go ahead and click that link that I put in there and be a member. We have over 1,800 members in there, and you can connect with like-minded people. And also, we also do have another part of our of the Multifamily Freedom Chasers. It's called the Fast Pass. It's a paid program. It's not very expensive, but if you're part of that, I would like you to put a 10 in the chat so we know that you're here and we can recognize you. Oh, Olga is here. Hi, Olga. Jerry, go ahead.
Yep. So
And
who are the
Caroline,
moms?
that's a part of the Fast Pass as well.
Awesome. So who are the Miles? That's me and my wife, Shelly, our 2 boys behind us there. We are commercial mortgage brokers, co-founders of Adventure Commercial Capital. We started this business about 4 years ago now. And the purpose in starting this business was to be able to serve the real estate investing community. We were real estate investors ourselves, running into issues with lenders that, were not honest, and we didn't like the way we were treated. We ended up starting our own business here, and our purpose here is to serve the community the best way that we can, and helping them to grow their portfolios. So now this probably got time for 2 or 3 people to raise their hand, tell us who you are. If you're a part of the Fast Pass, jump up and tell us what you think of the Fast Pass if you'd like as well. So raise your hand or just start talking.
So this is a good part of the Zoom that we have, you guys, so you can introduce
Okay.
yourself, tell everybody about your market, and
James,
connect with each other.
James got his hand raised, and
Hello,
Michael.
James.
So go ahead, James.
Hey guys, how's it going?
Hey, good man. Good to see you.
Good. So yeah, I'm James Thomas. I met Jerry down at the Real Estate Summit last December. It was a good event. We just booked our we're coming down again in March down there in Miami. So but yeah, I met Jerry there. Jerry's been super helpful, at least for me. Running quite a few deals through him. I'm here in the Indianapolis market, which is a really strong market, not too far from you guys too. I think you guys are in Cincinnati.
Yep.
But yeah, things are going well. I just put in a nice offer this week on a deal that's 315 units. I'm finding potentially some really strong, partners in this deal. And then I also got another small deal. I think you looked at it, Jerry. It's like 39 units. So I'm getting some offers out there, trying to lock down on
Yeah.
1 or 2 of these deals. And yeah, you guys have been super helpful. Just being able to just at least feel the confidence on a deal that could go through, at a certain level. So, but yeah, I'm excited to learn today. Definitely been trying to get on these calls for quite a while now. So it's great to be here.
Awesome. Good to have you here, man.
Glad to have you, James.
And Michael.
Can you hear me?
Yes.
All right. So yeah, Michael Healy. I'm in the market. My wife and I are interested in getting our first deal under our belts, looking to capitalize on all the growth in our city, especially with all the sports coming to town. I'm, sure we met at a 10X event. That's how I might have ended up with you guys. Ended up with my contact info or something like that. I'm pretty sure that's. We might have had lunch maybe at least one time too. You guys look really familiar.
Okay.
But anyways, yeah, looking to also kind of on like how big I can go on my first deal, not having a whole lot of, not being able to do it by myself, obviously. And that's kind of like stuff that I'm looking at right now and learning how to get the debt and just connecting and networking with you guys and building my network. And that's what I'm here for.
Awesome. And you cut out when you was talking about where you were located. What town are you in?
I'm in Las Vegas, Nevada.
Okay. Okay.
Yeah.
Yeah, that's definitely a booming area out there. So
Yeah.
okay.
Awesome. Glad to have you, Michael.
Yeah, for sure. And the last one of the evening, Caroline. Is that how you say it, Caroline or Carolyn? Oh, you're muted.
Oh, hi. Can you
Yep.
hear me?
Yep, now we can hear
Yeah.
you.
Okay, cool. So I'm spelled like Caroline, but I'm pronounced like Carolyn.
Okay.
So I'm Carolyn, and I'm a Marylander.
Nope.
And so I actually I haven't scored my first deal yet, but I've been reading the Bigger Pockets books, and I joined RE Mentor, I want to say back in October, and I've been working with them trying to score a deal and doing everything I can, trying to educate myself. So I'm hoping that I will soon.
Awesome.
Trying to network, do what I I'm sorry, I'm repeating myself. I'm a little nervous. I'm not very I'm based I'm sorry, I'm more introverted.
Yeah, no, you're doing great. Go ahead.
Doing a great job.
Thanks.
So, you said you're a real estate lender?
No.
No, I'm not a lender. I'm new to real estate. I just
Sure.
I recently created my LLC because I want to be able to have my when I do acquire a property, I don't want to have it in my own name.
Yeah, for sure.
But I see I'm still trying to learn the ropes and not have to do everything myself, but I'm trying to find someone to partner with.
Yeah, awesome.
You're in the right space, Caroline. Joining these Zoom calls will help you do that.
Thank you so much.
Yeah, thanks for being here.
Thank you.
Of course.
And David.
Hey, what's going on, guys?
Hey,
Thank you for taking your time, Jerry and Shelly. Appreciate it.
for sure.
Yeah, so I just want to introduce myself. I'm currently residing in New York, about an hour outside of New York City. I have a few properties down here as well. Multifamilies have like 6 doors, but I realized the money's really in the larger multifamilies. So I have a few properties right now in a LOI for in Alabama and Mississippi. That's kind of where I'm going right now at the moment, just to kind of get my feet wet a little bit with the larger multifamilies, learning how to scale it and really create a operations team. And I guess really came here to join just to kind of create capital partners, right? That's my biggest thing right now, is just really getting the equity partners, even just private funding, anything of that nature, and
Yeah.
really just keep learning and how to structure the debt and how to utilize it as much as I can as well.
Awesome. Well, cool. Good to have you here, David.
Appreciate you guys.
Thanks,
Thank you.
David.
And
We got time for one more.
this will be the last one. Jason.
Hey, real quick, I think 2 weeks in a row, so I'm excited. Finally,
Yeah.
only been connected for a couple of years now, Jerry, and we're gonna get our first deal here
Oh yeah, for
soon.
sure.
So I'm here really just to network, and the last couple of years trying to get into multifamily, it's been difficult just because of the debt market. I've been able to really create a lot of relationships over the last year and a half, and now it's about execution. So I'm just trying to be here on a regular weekly basis now. Appreciate what you bring to the table, Gary.
Awesome. Glad to have you here, Jason.
Thanks,
Well,
Jason. Also, everybody, like Jason said, he's here to network. This is what we use this platform for. Go ahead and throw your information in the chat, in your buy box or your market, whatever you want to call it. And also connect with Caroline and help her out a little bit.
Yeah. For sure. And so we'll get started here with the current debt market. Where current rates, the Fed rate has been unchanged. We're still at that 5.25 to 5.5. It is the highest we've seen in 22 years. The Treasury is up about 20 basis points since our last call 2 weeks ago. So rates are up about a quarter point. Both treasuries are up. The 5-year treasury's up like 30 basis points. 10 years up right around 20 basis points. So the treasury rates or the treasury yields, why we look at those is the treasury rates determine the rates we pay on most multifamily debt. There's other, when we're looking at your good debt for multifamily, being like agency, Freddie, Fannie, most of your bank rates and things like that, CMBS, they're all based on the treasuries. So that's going to determine your rates that you're going to pay on multifamily. So on a day-to-day basis, if you kind of want to know what your rates are going to be, you can look CNBC. I've got it pulled up here on my phone right now. I keep it pulled up. So I don't know if anybody can see it, but I have got CNBC, the 10-year Treasury, 4.311. It's moved a little bit since I put this in an hour ago. But I can look here and I know if I'm looking at a small balance, I'll talk a little bit more about what small balance and conventional are in the agency space. If I'm looking at small balance and I want to know what is my rate going to be on this apartment, I can look at that 10-year Treasury. I can add 2 to 3 points to that on a small balance loan. Small balance is up to 2 to 6 million with Fannie, 2 to 7.5 million with Freddie. So you got that 4.2, 4.3, and I want to figure out what my rate's going to be. I'm going to add probably 2.5 points to that. My final rate will be like 6 and 6.8. On the conventional end, if you're above the 6 million or you're above the 7.5 million for Freddie, I add 1.5 to 2.5 for on conventional. If it's, let's say a loan amount of 10 million, I can add 2 points to that 4.3. I'll be at like 6.3. So just to kind of give you a ballpark, if you figure the rates on that, that's kind of what your spread's going to be. There's other factors that determine, what those spreads are, like asset quality, the quality of the borrower, location of the property, all these things. But that's just kind of a good ballpark if you're wanting to do some quick numbers. Right here, this is current rates. Freddie Mac, this is 1 million to 7.5 million loan amount. This is where the rates are. You guys can take a screenshot of this.
Go ahead and hit your slideshow button so we can be a little bit larger.
Sure. That better?
No, it's
No?
loading.
Oh,
Maybe
okay.
that one. Share it on my end if you want me to. Or
Uh,
if everybody's seeing it fine, go ahead and exit out of it. I'll take over here.
let me. You got it? Okay. There we go.
All right. Can you guys see that better?
I see it
All
good.
right.
I could
So
see it
take a
before.
screen. I'm sorry, what?
I said I could see it before.
Oh, well, when you try to put it on the larger screen, it said loading.
Okay.
So here, everybody can take a screenshot. Do you want me to move to the next one?
Yeah, go ahead and move to the next one. This is the Fannie Mae. We'll talk a little
Quick
bit about.
screenshot, guys. Next one.
Yeah. And we'll talk a little bit about what the Fannie Mae and Freddie Mac, the different roles they play. That kind of thing.
The first one was Freddie Mac. This one's Fannie Mae.
Yeah. And this is the
They're
small balance.
slightly different. Mm-hmm.
Yeah.
Go ahead, sorry.
Yeah, this is the small balance rates. On the Fannie side, you're 2 million to 6 million for this SBL, they call it, or the small balance loans. That is, 2 to 6 million. Now, when you're looking at something between 1 and 7 or 1 and 2 million loan amount, the underwriting criteria gets a little tougher. They like the bigger deals. The smaller deals, if you get below the $1 million mark, you're going to have trouble finding anybody to lend on them. And when you do find people to lend on them, you're going to be paying, anywhere from 9 to 12, 13% on those deals. And the reason behind that is, the banks know what they're lending on. They know what the default rates are. On those smaller deals, the default rates are through the roof in comparison to the larger deals. So the rates, show that risk to the banks. So you can move on to the next one. So continuing on with the current debt market update, we're still in a stagnant market. We've been that way for over a year now. There is a lot more opportunity coming. And I'll take a second to kind of explain, and I'm sure a lot of you guys, guys and girls, if you've been in real estate and watching and learning and listening to people, they talk about $2.7 trillion in debt maturing by 2027. And some of you might not know what that means just yet. When we were looking at the last slide and it was saying, 5 year, 7 year, 10 year, if someone took out a loan and you had a 5-year term, it might be amortized over 30 years, but that term or that rate is locked in for 5 years. At that 5th year, the rate goes adjustable. So where they might have been paying a 3% rate or a 3.5%, that rate now is jumping to 7 or 6.5 or something like that. And when you have your rate jump like that, it could mean the difference in hundreds of thousands of dollars a year that you're paying on your debt service now or on your mortgage payment. And that puts people into negative cash flow on their deals. So when we're talking about $2.7 trillion of debt maturing, if the rates hadn't jumped up the way they have, it wouldn't be a big deal. They would be able to refinance and they would be able to keep moving and cash flowing. But because the rates have jumped up so drastically over the last year and a half, when these loans mature, they're going adjustable and their rates are doubling, sometimes more than doubling. And it's putting them into what you would call technical loan defaults, where their DSCR now is supposed to be a 1.25 and they go down to a 0.9 because they're paying out more than what they're getting in, and it's putting them into technical default. And these banks are going to start foreclosing and trying to find other owners for these properties. So lenders are starting to list properties. We got almost 600 billion maturing in 2024, 540 billion in 2025. And these people, as these properties, these loans mature, these people are going to be forced to sell. And so when they're forced to sell, they're now selling at a loss a lot of times. So that's the opportunity that's coming to the market. There's a major correction happening. We see deals all day long now that this guy, maybe just one as an example, they took out an $8 million loan. They bought a hotel for 11 million bucks, took out an $8 million bridge loan, rehabbed a bunch of the hotel, got it, better looking, did all the things they need to do. Well, the rates have jumped up. They plan to refinance and refinance at $8 or $9 million. Well, now since the rates have jumped up, the most debt that we can get them is about $5 million. And so they owe another $3 million beyond that. So if they want to refinance, they're going to have to bring $3 million in cash to the table to refinance. And the property right now is probably only worth, because of the higher debt, the property's only worth what they owe on it. So if they go to sell it, they're going to have to sell it for the $8 million. Somebody's going to get a decent buy. They're going to get $5 million in debt, have to put $3 million into it. But that person that now holds the property right now and is $3 million, underwater with their debt, they've got $3 million in investors that they're wanting to get paid off. So they're going to try to get 11 million out of this property because that's what they got into it. But it's not going to happen. They're just not going to be able to get that money. That $3 million in equity that they raised from those people is gone, and they're going to have to sell at a loss, unless they can come up with $3 million, which they don't have. And this situation right here is happening over and over and over and over again. Different amounts, different types of borrowers. And these people that have this one own a bunch of hotels all across the country. And back when they bought the hotel, they were probably trading hotels at 7 and 8 caps. Now hotels are 10 to 12 cap. Because the interest rates are at 8, 9% now on hotels. So a lot of people in trouble, and it's just going to continue going that way. And so the people that are here and learning and making connections with capital and all this kind of stuff, you're going to be able to capitalize on these things. So go to the next slide. We'll go on into the
To the next slide. There was a question in the chat.
okay, yeah, go ahead.
Jason said, what's the typical IO period you are seeing?
That's kind of deal dependent. We can go full, like if we do a 10-year term, we can go full 10 years on interest only. Sometimes it might cost you 15 basis points or something like that. But certain occasions, if it's a property that the lender's really wanting to lend on, they'll offer full 10-year IO without any cost. It'll be same price. So agency financing, Freddie Mac and Fannie Mae, you guys are these kind of household names. They're organizations put there by Congress to provide workforce housing for the masses, to make affordable housing. Mission-driven. They're mission-driven organizations. They're there to provide affordable housing. We talked about the small balance loans and the conventional. Go back. Right there. There we go. We talked about the small balance loans. Freddie's small balance is 2 to 7.5. Fannie's 2 to 6. Deals above 1 million and below 2 million can be done, but will be more expensive. Sometimes a quarter point higher when you're looking at the smaller ones, and those are typically a little tougher to get done. I'll just say it that way. There's a lot of nuances when you get the smaller deals. Freddie and Fannie will lend up to 100 million, even beyond 100 million. When you get to the conventional above 7.5 and above 6, the rates drop. Rates get better. Terms get a little better. At that point we can start bringing in, second mortgages, second loans. When you have the bigger deals, we can bring in, mezzanine debt and all kinds of things to help out with those. But go on to the next slide. SBL stands for small balance loan. I'm not seeing all the questions in there, so I just saw that one. The differences between Freddie and Fannie. There's not a lot of differences. Underwriting is kind of the same for each. General criteria is the same. Where you get the difference is Fannie performs better in the smaller markets. They like the more rural areas. Freddie likes the larger markets. So you're going to get a little bit more favorable terms if you're in Miami or Chicago or something like that with Freddie. A little better with Fannie if maybe you're in Tulsa or even outside of Tulsa or somewhere in Kansas or something like that. So go to the next one. Property criteria. When we're looking at what the agencies will finance, when we're talking about property criteria, I will say the agencies, or Fannie Mae more than Freddie, they will lend on mobile home parks. But these criteria need to be met. Mobile home parks, generally things they like to see in mobile home parks. There's just something I'm mad I didn't have this plan to talk about, but if you have paved roads, if condition of the mobile homes that are in there. All these things are taken into consideration, but they will lend on those just like in multifamily. The property criteria needs to be stabilized, 90% or better occupancy for 3 months. Occasions where, you know, we can sometimes get away with a T1 that shows 90% if it's a situation where it's just been stabilized, or if it's a brand new build, we get that occupancy above 90%. We can start the process of the loan. But they're going to be continually looking at that occupancy as we're as we're doing all the underwriting on the loan. So property condition inspection, property condition inspection will have to be completed on the most properties, appraisals, all these things. So that's property criteria. It's way different based on where they're at in the United States. Different parts of the country has different nuances to them. If you're out, we were just working on something, in Louisiana. It was kind of out in the middle of nowhere, and they were wanting to underwrite that deal to like a 155 DSCR. Fannie Mae was 155 because they didn't trust the market as much as they would, a bigger area. So, things agencies do not like right now. Military towns is one thing the agencies don't like to lend on. Military towns, one single employer towns, where you might have one big company that moves into an area, and they kind of build a town around that one employer. Not many banks or lenders like that. If that one employer goes away, their cash flow goes away, and all their tenants go away. Student housing used to be something that the agencies would do a lot more of. Right now, they're not liking it as much since COVID. They'll still lend on student housing at bigger universities, like here where we're at. We have, the University of Cincinnati here. We're not too far from the University of Kentucky, two big colleges. We can get agency financing and student housing in those areas, and for those colleges. Then we have smaller colleges like Xavier University or Northern Kentucky University. Those probably wouldn't qualify. So just as an example. So go ahead and go to the next slide.
I've got a question from Jennifer. She said, how do you determine what deals to get into? There are a lot of good ones with cash on cash returns, 5 to 9% to improve. That improves as time goes by. 2.5 times and 3 times total return in 5 to 10 years.
How do you determine? You've got to look at a lot of deals. I wouldn't jump into a deal because a sales pitch sounds good. If you're if you're looking to be an LP in a deal, I would look at a bunch of them before I jumped into one. I've seen some people recently. A lot of it's the market, but I've seen a lot of people jump into deals that have lost money recently. But I've seen people that have made money too. So I would just say, as a new person, it's harder to raise money. Once you build a track record, it's easier and easier. But I would be careful. I would make sure that there's people in that GP team that has done it before. When you're looking to be an LP on a deal, if you are, if you're looking to invest yourself, I would definitely start talking to investors that have done syndications and bought before, and I would start trying to talk to them and maybe partner with some of them. and jump in as a partner on some of these deals with people who are experienced. It's kind of the only way to get started. Coming in and doing a $10 million deal yourself without ever having done it before, unless you just have all the cash yourself to buy it, is tough. And you'll kind of see as we talk about personal qualifications here on the next slide, you'll see why that's tough. But you know, getting into rooms like this, there's people on here that have bought deals. Um, in this, in the Multifamily Freedom Chasers community, there's people that will partner on deals with you. And I would say start looking some of them people up and try to do some deals with them. Talk to them about what their criteria is. And when you're buying your first deal, you need to worry about your partner's criteria instead of your own criteria, maybe. So I hope that helps. So we talked about the property's qualifications for agency financing. Now, borrower's qualifications. There is qualifications for net worth when we're talking about, if you're able to borrow money through the agencies. Your net worth, or the net worth of the KP, they have what you call a key principal or a general partner, or there's a lot of different names for them, but that person signing on the debt, the sponsor, their net worth needs to be equal to or greater than the loan amount that you're getting. So you can spread that out if you're trying to borrow $5 or $6 million, and you've got a couple different partners, and between the four of you or three of you or however many there is, your all's net worth is combined equal to or greater than what the loan amount is. We can do that with all of you and qualify all of you together. Experience is really important when we're looking at agency financing. If you're trying to buy a 50-unit property, they're going to want to see that you've managed 20 or 25 units or 15 units or whatever it is. They're going to want to see that you've managed multiple tenants and that you have that experience of dealing with them. Sometimes someone that is very, very good on the net worth side or with the cash side and very strong there, you can get away. I mean, these with the agencies, a lot of these criteria are fluid. So let's say you have a higher net worth than what you need, and you don't have the experience, and let's say you bring in a really good property manager, we can sometimes get that experience overlooked because you have a good property manager that's partnering with you. So it's kind of fluid, but these are the general guidelines. On your first deal, generally they're going to want to see that you're within 100 miles of the property. That's going to help a lot because there's things that are going to come up that you're not expecting, and you're going to need to be there. Even if you have a good manager, a lot of times that they're going to want to see you there, see you close to the property. That being said, once again, that net worth number, if you're way exceeding what's required there, some of these other things aren't going to be as important. Or if you have a really strong property, even more important than the net worth, a really strong property, they're going to kind of overlook some of these as well. Strong management, sell for third-party managers. If you're buying a 50 unit and you haven't managed 50 units, they're probably going to require you to have a third-party manager. So go on to the next slide. And
Jerry,
yeah, go ahead.
sorry to cut in right there, but do you know how much how do you calculate what you think management should cost? Is there a way to do that, or do you know of anything like that?
On smaller stuff, it can be as much as 10%. When you buy the bigger stuff, 100 units or more, there are a lot of times, 3 to 5%. Um, you know, one way to do it is when you get the T12, I would look at what they're paying on the T12, what the management fee is there. That'll help you some. And then you can always call around to a couple of managers and tell them what property you're looking at and ask them kind of a ballpark on what they would charge.
Okay.
Yeah.
Yeah, I mean, I've been mostly looking at the T12s, but there's one deal that they've been self-managing, and I would probably prefer to. And I was gonna call some people. I just haven't done it yet. I didn't know if there's a general rule of thumb. So, but that
Yeah.
helped.
Yeah, I mean, smaller stuff like 50 units or less, you're probably going to be 10%. So, because I mean, it's a lot of work to manage 50 units, and they're not going to have somebody full time there because you can't afford to really, it's but each market's different when it comes to management. When I call my Freddie and Fannie rep and I give them that, they have it in their computer like, hey, this is Indianapolis. This is what, for this property, it's going to cost this much. And then they'll tell you if you have a manager that's coming in and charging more than that, they'll tell you, hey, we've got 3 other loans here on this same street, and these guys are only paying this. You need to talk to somebody else, So lender's your friend and your partner. So they'll help with those things as you go. Prepayment penalties on agency financing. When you're taking out a 5-year term loan at 6.5%, the investors that buy this loan or buy these treasuries or whatever it is, they're wanting to collect this 6.5% for 5 years. If you go to get out of this loan early, there's going to be a fee to pay. So when you're looking and you're trying to get the best rates possible, you're going to be looking at what they call yield maintenance on your prepayment penalties. Yield maintenance, if you try to get out of yield maintenance at the beginning or year 3 of a 5-year loan, you're going to end up having to pay that interest rate out for the remainder of that loan. Now, certain occasions where this won't happen is if you take out a 6.5% loan and when someone else is buying it, now the rates are 8%. The yield maintenance is probably going to go away because they're going to turn that 6.5% return into an 8% return, and they're going to be happy to get out of it. But if you're wanting to get out of year 3 and now rates are 4% instead of 6.5%, they're going to want to make up that difference that they're going to be missing out on. So that yield maintenance can be really expensive. Another way that they do it, and it's a little more expensive rates, you can ask for this when you're getting a quote, is a step down method. And so your rate will be a little higher because they're getting a little bit more of the money during that time, during while you're paying. But the step down method generally would be like if you're a 10-year loan, it would be the first 2 years you'd have 5% each year of a prepayment. Next 2 years would be 4, so it'd be 5, 5, 4, 4, 3, 3, 2, 2, 1, 1. Okay. Or if it's a 5-year term, it'd be 5, 4, 3, 2, 1. On that last year, you would pay a 1% fee. Year 4, you'd pay a 2%. Year 3, a 3%. Year 2, a 4%. So those are different things to consider when you're looking at at the agency. If you're wanting to get out of a loan, if you're wanting to sell a property in 5 years, or you have a 5-year plan, you don't want to take out a 10-year term because the rate's a little better. That you're going to pay for it when you go to get out of the loan. So, and this is another thing when people are selling a lot of properties right now, and they're selling these properties with assumable debt, and they're acting, when they're selling it with assumable debt, they're acting like they're doing you a favor by letting you take over their debt. Well, yeah, I mean, it'd be nice to get a property with a 3.5 or a 3.9% interest rate, but they're expecting to get a little bit better cap rate when they sell. But the big thing they don't want to do is they don't want to pay that prepayment penalty. So that's a big reason why we're seeing a bunch of that. So going to the next slide. I think it's the Q&A slide.
Okay. Oh no.
Oh no.
But I
Okay.
do have a couple of questions here.
Okay, go ahead.
I think one was asked and answered. Did you say net worth needed to be equal to the loan?
Yeah,
And
equal or greater.
somebody already answered. And how do you calculate net worth? What do you count into it? Units you are partnered with?
Yeah, if you own 10% of a $10 million deal, there's 4 million in equity. You own 10% of that $4 million. What is that as far as net worth? So you have a $400,000 net worth with that. You could take your home if you own a business. With us, we own a couple businesses. We would take any debt that we owe on those businesses, get rid of that away from what we think the business is worth, and we would count that as our net worth, our home, our rental property, whatever. And we're gonna calculate our net worth that way. So
Yeah, Jason said asset minus liabilities.
yep, that's right.
Does the primary residence count towards net worth or not?
Yeah, it does.
And Jason already answered that. Thanks for your help, buddy.
Yeah.
No, I like that you guys are answering these questions because it helps
Oh yeah, it helps move it along.
it helps
Jason's
move it
a
along. Thank
financial
you.
advisor, so
Yeah,
he's on
he's the
top
one. Yeah,
as well. So
thank you. No,
um,
be sorry, please. You're helping. So
yeah, oh yeah. So why use agency financing? You're going to get very favorable rates and terms. They're a mission-driven organization, so they're giving out um, really the best of the best rates and terms. Um, they're non-recourse with what they call bad boy carve-outs. So if you're caught committing fraud, they're going to come after you personally for anything that you've defrauded them of. Otherwise, they're not going to come after you personally. And then there's no limits. A lot of I deal with people different times. We're working on a loan for somebody right now that has borrowed over 20 million with their local bank, and the bank cut them off. They've got a few deals. They got 20 million in debt with this bank. They've been good to them. They've helped them not get this far, and the bank is now saying you're cut off. And we can't lend any more to you. We've got too much lent going to you now, and so now they're needing to go somewhere else to borrow money. With the agencies, they're not going to cut you off. You can just continue borrowing with them. There's no limits. So those are some of the good things with agency financing to consider. And go on to the Q&A slide. So any questions? And we can go on to the next slide. And if anybody has any questions, just go ahead, either put them in a chat or raise your hand or whatever. If you're looking at property or you're looking at anything that you're wanting a quote on, the things I need, T12s and rent rolls and OM is very helpful. A lot of times, the OM will have kind of an expense thing on it. But when we need a T12, we're wanting to see like historical. So, right now we'd want to see from, January to January. And we want to see that whole year's pattern in the property and see what it's done, whether it's gone up or gone down, or expenses have gone up or gone down. We kind of need to see all those things. A summary of what you plan to do with the property. If you have no OM is an offering memorandum. That is the sales pitch that the brokers put together to sell the property.
I got a couple questions.
Okay, good.
Are the agencies lending based on asset value or credit score?
The agencies are lending based on the income of the property. Income and expenses. So if you're familiar with what DSCR means, you have, they're going to lend to that DSCR. If you're going for a home mortgage, you have a debt to income ratio. With commercial real estate or business acquisitions, anything along those lines, they're looking at a debt service coverage ratio. So they want to see the income, and then they want to see the expenses, and then what the debt is on the property. And they're going to, that's a formula they use. They want to see it 1.25 better, the income, 120 or 25% better at least than what all the expenses are. So
Okay, and Jason wanted to ask about trapped equity.
okay.
Yeah, I might have asked about this last time, but I was talking to a client today, and he's a real estate investor, but has over about $1 million between his primary and most of his rentals. What are your thoughts on how best to leverage that, assuming they do have great rates already, right? We don't want to refinance into a higher debt.
Yeah. We kind of have that ourselves. We've got a lot of equity sitting in real estate right now. And with us, we're just leaving it there. It's not really, I mean, I'm a lender. I don't make money unless people are refinancing or buying or getting new debt. But I'll tell you, like, what we're doing personally is, we're not taking any of that equity out. We're leaving it there. And we don't have to have it. And so, I'm not going to go and take it out. My 4 or 6% loans that I have right now, I'm not going to exchange them for a 7 or 8 or 9% loan, and I'm just not going to do it. Now, if I could do that, I'm guaranteed to bring in 10% above that. Yeah, maybe. But we just haven't done it ourselves. So, I'm happy to refinance anybody that wants to refinance. But as far as me personally, that's not what I'm, it's not hurting anything keeping those good rates. I mean, that's a valuable thing. Those good rates are on a property right now. So
I would just, encourage, since there's a nice platform here, just encourage those that are out there just to be careful, because there's a lot of social media out there, where we want to get into the business, and it's, hey, use your equity. Although it can be done, it can be done and can be leveraged right, it can also really hurt you. So, just be careful. If anyone wants to talk more offline about that, definitely give me a call, because I'd hate for someone to make the wrong choice to go get $50,000 to put into, a deal that may not be the right thing for them.
yeah, for sure, for sure. Yeah, I mean, that's that. Yeah, go ahead.
I was going to ask you if you have time for a couple more questions because it's almost 9 o'clock.
Yeah, we can do a couple more, and I'll slide through these, and we'll call tonight.
So I'm sorry. I don't know how to pronounce your name. I'm going to call you Rack. He said O&M, operating and maintenance. I'm guessing he's meaning OM for operating memorandum.
Operating memorandum. Yep, that's the sales pitch from the broker.
Okay.
Yeah.
And I didn't know if there was like a different one I missed that you were talking about. And he said, is SBA loan an option for real estate or not?
Certain types of real estate, it is an option. SBA can be used for hotels, smaller hotels, self-storage. If you're buying a business that has real estate attached to it, let's say you're buying a construction company, and that construction company has a big, nice office with a warehouse attached. You can buy that real estate with an SBA loan. I've seen people pull off deals where they buy a business like that, and they'll sell off the business by itself and keep the real estate. You know, if you're buying a restaurant, it has real estate. You can use an SBA to buy that real estate. So the big thing with SBA, if you're buying a piece of real estate for a business to use, if you own a business, you can buy a piece of real estate for your business, but you have to use 51% of that real estate for your business. So you could use half of it or a little more than half for your business and rent the other half out. So there's a lot of different ways to do that. So other things that we need for quotes as we move forward on quotes: SREO, schedule of real estate owned, PFS, or personal financial statement. Go on to the next one.
Okay, here's our contact info. Sorry, we'll put our contact info up here in a minute. And I got one more question. Constance said, do you do meetups? She's also in the Cincinnati area.
Oh yeah, we'd love to. We would love to.
Yeah.
Yeah, go ahead and put our contact info up. This week's verse.
Go into the chat and
Time I'll drive. Hello.
So what can you do today? Make sure to be ready to buy real estate in the future, or to be a KP or a sponsor in the future. Make sure your credit's in order. They tell you all the time. I hear people say, even Grant Cardone says this, and it's not 100% true. I can buy real estate without a credit score. Well, you know, when you're first starting out and they're looking at you on your first deal, your first 10 deals, they're going to look at everything. They're going to look at your credit score. You're not going to qualify for agency debt at a sub 620 credit score. So that is important to have. Work on your personal financial statement or your SREO. Start putting them together now. Get your bio together. You're being educated here tonight. Put those types of things in your bio. Work on raising capital, talking to people, making more money. Our referral program is a good way to make more money. We pay out referral fees. And I'm going to blow through these things because it's after 9. This week's verse, Proverbs 29:18. Where there is no vision, the people perish. This can be taken in a spiritual sense, and it can be taken in a business sense as well, or even a family sense. If you and your wife or your husband don't have a vision for what your future holds, and have a future that you guys are looking forward to together, you might not have a future together at all. So next Zoom topic, March 6th. We'll be talking about what are the 4 C's in commercial real estate lending.
Yeah, we will send out, actually, we will send out information on our referral program. If you're on this Zoom, you're going to be captured and put into my email list. So you'll be getting the link for the referral program. Sorry, we have taken so long to start one. My mom broke her arm, and we've been dealing with that for the last 2.5 weeks. And we had other stuff before that, like basketball.
Her mom lives with us, y'all, and she broke her arm. She's got dementia. And so for the last 2 weeks, all we've done is remind her that she's got a broken arm and she can't use it. So it's you know, it can be funny sometimes, but after a few weeks, it's not funny no more. So
We got somebody that raised their hand. One more question, and that's it.
Yep.
Go ahead.
Last one. Go ahead.
And let me know how to pronounce your name.
It's Rakshanda. It reads the way it writes.
Rakshanda. Okay.
Yeah, and also consider Rockstar and Roxy. But hey, several people are asking about referral information. So not to step in your lane, but just wanted to point it out. Thank you. There's several chat messages they're asking about referral program. Thank you.
Oh, the referral program. Yeah, we'll do a Zoom on that here coming up soon.
We have your email address, and we will send you the link and the date and time for the referral program.
Yep.
And we're going to be doing a Zoom on it, so you will be able to hear a little bit more about it in that Zoom call.
Yep.
Here is the Freedom Chasers. We have a WhatsApp chat. Go ahead and scan that QR code. I saw somebody had their QR code in their picture on their Zoom thing, and I thought that was a clever idea. But go ahead and scan that, be a part of our WhatsApp chat. You can connect with anybody every day, all day long on that chat. So and then you can also find us. Oh, did I miss that one? Yeah. YouTube, Spotify, Facebook, and Instagram, and WhatsApp. Here is our contact information. That is Jerry's phone number, his email address, and my email address. That's how you can reach us. Or if you scan the QR code at the bottom there, you will get his Hi Hello card, and it'll have everything on there. I'll give you a second for that. And sorry if you guys have more questions. I don't want to keep everybody held up. It's 9:06. Here is our Facebook community again. Go ahead and join the Facebook community, and you can get a lot of questions answered there as well. Thank you, guys. And I'm going to leave you guys with some music. So if you want to stick around, that's fine too.
Have a good night, everybody.
Thank you.
Thanks.
Good night, guys. Thanks for your time.
You're welcome.
Hey Gary, I'm gonna send over that P&L and rent roll on that deal that we're working on.
When I walk through the door, I'm talking cash flow. And if you know, like I know, you're getting cash flow. Rule one, getting money, never losing hope. But I'm broke, but now I'm living adding digits, comma zeros and some decimals. And I wish you would try to test me, yo. You should listen to the lesson, no. Masterminds out of Mexico, I invested though when I let it grow. Benjamins, I got a pocket full. Print your income and your taxes low. Spend it right and then invest some more. And if you don't believe me, ask my doctor down. What you mean? You mean Uncle G? Planting seeds for these money trees. Who got my money, please? Everywhere you wanna be like Visa, MasterCard, American Express. I bought the bank and I bought the checks. I buy apartments, I send checks. Yo, billionaire went undercover, help y'all discover who did it best. Just bought 2 choppers, can't wait till they see the face and they see what I do next. When I walk through the door, I'm talking cash flow. And if you know, like I know, you're getting cash flow. When I walk through the door, I'm talking cash flow. And if you know, like I know, you're getting cash flow.
Yeah, and only then do I buy something stupid. How stupid can you go? You can go as stupid as your cash flow.
You know what heals all ills? Deals. Look who went from meals to bills. It's eat what you kill when you're in the field. In the pipeline overflowing, I don't drip, I spill. We don't seek